Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone. Today on FIN-LYT's podcast, we are talking about several topics, joined by two of the smartest minds at EWA here, Nick Stonesifer and Ben Ruttenberg. Nick, give us the heads up. I know you're leaving on vacation to Colorado for a week. Maybe we're catching it at a good time here before you go, but what's the topics today?
Yeah, topic today, we're primarily going to take a look at international investing. So taking a look at, recency bias. In the past 10 years, international markets compared to domestic markets have lagged significantly. So why invest internationally? It is something that we believe in and something that we're going to back up and justify here today. But we're going to take a deep dive today into international investing. Absolutely.
And then specifically, Nick, we're going to put you on the hot seat. So international specifically, ETFs versus mutual funds, we're going to ask you, what's the difference between the two? Break it down. We actually have had several clients ask us for some education on that. And then, why do we select ETFs or mutual funds for each category, specifically international? I think is a great way to explain that. Perfect. Well, we get questions really frequently over the last 5 years specifically about why are we invested in international, the returns. Our reports are very clear. It shows by asset class, here's the returns of every single holding, a fund by asset class, et cetera. So internationals have definitely lagged. So Ben, give us some data on, the past 5-10 years. Why do you think we're getting this question?
Yeah, you're right. It's something that when we work with clients on educating them about EWA's investment principles, really the first three are asset allocation, diversification, and having a long-term time horizon for funds that are invested. So within asset allocation, we want to make sure that we're investing in each asset class, United States and international. So if we just look at really the last 5 years, so 2015, 2016, 2017, 2018, 2019, 2020, there was only 1 year in that time frame that international equities, both developed markets and emerging markets, outpaced U.S. equities. So,
which year was that?
That was 2007. So
okay.
International outpaced U.S. by 3.2%, but every other year in that time frame, U.S. outperformed by a pretty significant margin. 2015, 2.2, 2016, 11, 2014, 18.6. 2011, 14.3. So really in the last
And those
decade,
aren't just returns. Those are how much returns above the U.S. got over international.
That's correct.
Okay.
That's correct.
That's big. So obviously, if you're looking at a statement, you're saying I did, 20, there's been several good years in the past, 2022, not so much, but this fund did 25%. Why did international do 3%? That's a valid question, right? So absolutely. I think it really boils down back to the investment principles of, why are we investing? Do we want our money to ultimately dictate how we live our life? So for example, if everything is in one fund, like the S&P 500 index, do we want to pause our life when we have an inevitable downturn? Or if it takes, like the last decade after the tech bust, 2000 through 2002, there were very small returns in the U.S. because of that. So do we want to pause our life just because, what our money is doing? Or do we want a life by design where the money's goal is to support our life no matter what the markets happen? So that's asset allocation. The second thing is diversification, which Nick will get into when we talk about the ETF. That just means holding bundles of companies in each category. And then the third thing is, really, we ask, if you're investing in a time period of under 5 years even, you shouldn't be invested from the get-go.
Sure.
Right? So a lot of those questions, I think it's just we need to make sure that an advisor understands the client's objectives. Any money you put in the market, whether it's internationally, U.S., whether it's diversified, asset allocated, it has to be long-term money. It has to be allocated in a way. So really quick before we start getting into the weeds of this, just to go back to our basic principles, over the last 15 years, so we pulled this data of our quilt, of our asset allocation quilt. We love this. So the U.S., the returns of large cap holdings from 2006 to 2020 have been 9.88%. Now, the corresponding risk of that, so standard deviation, has been 15.12%. So just in general, we're going to use round numbers. We'll say 10 and 15. So that means standard deviation. So on a normal year, if the average return was 10, you could expect 15% below that or 15% above that. So you could expect anywhere between -5 to a +25 in a given year. And then over a long enough period of time, you'd go back towards that mean of that close to that 10% return. Now, if you look at international over the same time period, the returns were almost half. It was 4.97%, and the risk was actually higher. So the risk was 17.48%. So you got half the return, and you took even more risk. So we're like, well, that doesn't make any sense. And then emerging markets over that time period, 2006 to 2020, they did 6.95% returns, and the standard deviation was 21.76%. So if you look at that last, 2006 to 2020, say, well, I should have just been invested in large cap. Well, then if you look at on a higher level how asset allocation works as a whole, and really we look at 7 categories, having all 7 categories in that same time period, you'd have gotten a 7.11% return. So greater than emerging markets, greater than international, not quite as much as large cap, but you got that at half the risk at a 9.78%. So as close as possible to a 1-to-1 relationship between risk and return. So asset allocation diversification, it's not about getting the best rate of return. I want to make that very clear to the audience. It's about getting the best return for also the lowest corresponding risk that comes along with that return. And if you're looking at a financial plan and goal-based objectives of I want to retire, I want to be financially secure, I want to send my kids to college, I want the money to be there. I don't just want to die the richest person in the graveyard and accumulate massive wealth for no reason. You have to pay attention to the risk versus return scenario. And that's in general, if I were to give one blanket statement before we get into the weeds, that's why you invest in international. That's why you invest in emerging markets. So when you add those 2 sectors to the US, it really does magic for the risk adjustment of the portfolio. It really does magic for your life by design, where if the US economy is in, the lost decade, you have optionality of where to pull money from. And so your vacations, your life, and your financial security don't pause. Your life continues to happen regardless of what's happening in one specific sector of the market.
I just want to piggyback off that because that's such a good point. And there's real world data to support that. So if you invested $100,000 just in the S&P 500 index in October of 2007 and you didn't touch it and you let it sit and you looked at your statement in December of 2020, your 100,000 would have grown to 319,000. But
so that's over
over that 2000 from 2007 to 2020. So over that 13 year time frame. The key component here is, though, again, you invested in 2007. So by the time March of 2009 rolled around, your 100,000 would have been down to 45,000. Again, if it was just in the S&P 500, which mirrors 500 of the largest U.S. companies in the world. That's a negative 55% on your investment just in that 2-year time frame. Again, if you had let your money sit until 2020, your 100 would have grown to 319, but you saw a dip of 50% in that 2-year time frame. If you were invested in a portfolio that had half of the downswings, but also half of the upswings, your 100,000, again, same exact time frame, would have grown to essentially the same number, 320,000, but you would have had a downswing of 34% in that 2-year time frame where we saw the Great Recession, as opposed to the 55% we saw if you were just in the S&P 500. So what does that mean? Returns, you ended up getting to the same place, but you saw 20% less of a downswing because you had exposure in other asset classes and you weren't just subject to United States large cap, the S&P 500. So exactly what you just said, the return conversation, we're not seeking to get just the maximum amount of returns, no questions asked. It's the maximum amount of returns with the appropriate level of risk that we're taking in the portfolio. So having that split of asset classes being invested in different buckets that we'll talk about in a little bit prevents those significantly large downswings when they do occur. And we don't know when they will occur, so it's important to always have that downside protection.
No question. So I ran some numbers here to coincide with that. So let's just say we were sitting down with a high income earner, like a doctor or something, starting to invest from scratch, right? So they just paid off their student loans and now they have a high cash flow. They're old, so they're trying to catch up. They invest $5,000 a month and they put it all in a U.S. holding, right? So they're $5,000 a month for 10 years. They hit 10% a year for this first 10 years. Then you guess where they're at? The $5,000 a month.
I'll pass it to the
60,000. So that's
right?
60,000 a year over 10 years. That's they've invested 600. Now 10 years is not a large amount of time for compounding interest to work, but still is large enough. 10% is great. Where do you think they're at?
10% returns over 10 years? Oh man. Say $1 million.
You're pretty close. So $1,032,000. We'll forgive you. 32,000 off.
That was
All
a
right.
lucky guess.
All right, you deserve a vacation, Nick. You deserve a vacation. All right, so they're at $1,032,000. So they've invested $600,000. Their growth is $432,000. And the point I want to make, piggybacking off of what Ben just said, is if they're in just that large cap holding, right? So they just hit 10% over 10 years. Their 600 has grown to $1,032,000, $5,000 a month for 10 years. 1 year, which we know could happen, like that October 9th of 2007, we saw the top of the S&P 500. And then what we saw between October 9th of 2007 to March 10th of 2009, we saw a 54.9% drop. So let's just say that's a 50% drop. And that million is now worth 500,000. So 10 years, we felt really smart getting those 10% returns. One drop, we're now down to 500,000. So I just want to point out that is now less than what this person actually saved. They saved 600. Now they're down to 500,000. Now, let's say they get a 50% return the next year. So that's just a fluke. Are they back to even?
No, Matt, they're not. Because we need, again, if we're at $1 million, we drop 50%. Now we're at 500. Let's say we need to double our return. Again, we're doubling off of the 500,000 that we're at now. So if we have the 50% drop to get us to 500,000, and then we have a 50% recovery, we're at 750,000 because that 50% recovery is based off that smaller number.
So I think this is why, Warren Buffett says like the number one rule of money is you don't lose money. And then the number two rule is like you don't forget number one, right? So it's so important because those bad years can just ruin a life's work, right? And I think that's also like similar, like it takes a lifetime to build a good reputation. One moment you lose it. In investing it's the same thing. You can have a lifetime of amazing returns, and one bad decision you could, really, really set yourself back. So that's why we invest in international. In a nutshell, it reduces risk. It's not about, a conversation of what do we think is going to be hot next year? What do we think is going to outperform or underperform? But with that being said, some of that, the business cycle data we do take into very strong consideration with the weightings and the types of international investing that we do. So let's start getting into that. So Nick, let's start first. Let's talk about ETFs versus mutual funds. So there's, I know you outlined this for me so I can ask specific questions. So ETF and mutual fund, just in general, I've got a couple categories I want to ask you about, 7 specifically, but just in general, what's the breakdown? What's an ETF? What's a mutual fund?
So yeah, I guess I'll start with, I'd be amiss to not include, in today's investment landscape, I think we make generalizations about ETFs versus mutual funds with active versus passive investments. Some mutual funds are passive in nature and some ETFs are active in nature. So for the purpose of this conversation, we're just going to talk active versus passive investing. Primarily speaking, ETFs tend to be passive in nature and mutual funds tend to be active in nature. Just kind of put that blanket statement out there. But so yeah, where do we want to start? Just the basic breakdown. What is an ETF? What is a passive investment versus
absolutely.
an active? So taking a look at like a passive ETF, it's priced according to the market, minute by minute basis. You're actively buying and selling shares based on their market prices, versus a mutual fund, which is priced at the end of the day, net asset value after market close. And you're typically buying dollar amounts increments for that. So passive investments tend to be less costly, lower expense ratios than their active comparisons there, because an active manager is attempting to beat their respective benchmark and their indice or their index. Excuse me. That's the nature of it. Versus a passive investment is trying to track with an index or with a benchmark. So rather than beating the benchmark, let's invest along with it. Versus an active manager that's making active moves to hopefully outperform the respective benchmark. So there is an added cost there for sure when you take a look at a mutual fund versus an ETF. You're paying for the marketing, the distribution, and also the money managers and their attempts through their research and their analysis to beat their respective benchmarks.
Gotcha. Okay, so you've obviously hit on a lot of the questions I was in it. So let's talk about, for just in general, like, is there a minimum investment for an ETF because it's just available in the market? And then same thing for a mutual fund. Talk about, the different, some mutual funds could have minimum investments, some may not, et cetera.
Exactly. Some mutual funds, they are open-ended in nature, so you can continue to buy mutual fund shares at will. But some mutual funds do have minimum investments. Some you can get in for $100, $200, versus an ETF. You're purchasing whatever the price is per share. So you're buying a share, at least a share in an ETF, at whatever the open market price is for that ETF.
Awesome.
Price per share.
And so both of these, just on a more basic level, like an ETF, you could have a large cap ETF and it could hold 200 stocks in the US. And if it's a large cap ETF, large growth ETF, it would be 200 growth oriented companies. You're probably going to see a lot of tech exposure, a lot of companies that are growing versus paying dividends. And then if you do the same thing, like a large cap value or dividend paying, a dividend focused ETF, that would be more mature companies, utility companies that are going to pay a dividend aren't going anywhere, but less in general, maybe less risky because of their business models versus like a tech company. It may soar, but it also has a higher risk as well. And then mutual funds is the same thing, but instead of like going after a broad basket where that doesn't change, a mutual funds manager is actively trying to say, well, Pepsi is going to be better than Coca-Cola because of this, or we're going to go heavily into the financial sector this year because of reason XYZ. Whereas if you're holding an S&P 500 ETF, that's going to track the ETF. And there's really not going to be any kind of thought process or reasoning behind the 500 companies other than trying to mirror the index, versus a mutual fund may go in and try to select and overweight certain sectors, pick companies over other companies, et cetera. So
absolutely.
Talk to us about, it's with technology specifically, and then all the information that's readily available in the US specifically. So I know this is an international podcast, but this is going to lead us into the international aspect of this. If I'm looking at the EWA portfolio and we do a video every quarter talking about it, I don't see any active stuff in the US sector. Why is that?
So we've done some different research. We've pulled research reports from multiple outlets, and really what it comes down to us is, over the long term, as you stated earlier, our investment philosophy, our strategy in general, focuses on long-term time horizons. But over the long term, the success of an active manager beating their respective benchmark diminishes greatly. In the short term, you're talking maybe it's a coin flip in domestic markets. So it really comes into, are you getting an active money manager that happens to be in the small, in the small category of active managers that's actually doing this with success on a consistent basis. So in short term, 1 year time period, if it's a coin flip, maybe you have a decent amount of managers that they're doing pretty well there. But as you start to take a look at the research and you spread it out over 5 years, 10 years, 20 years, it turns into maybe 5% on average of domestic money managers, active money managers, are beating their respective benchmarks. So with that much at play there, we personally don't see the value in going all active in domestic markets when the overwhelming majority of the time the active managers aren't outperforming the respective benchmarks.
Nick, I love that you use the coin flip because in the 1 year U.S. large blend, 54%, a little bit over half, have outperformed. Active managers have outperformed the index. If you look at large cap growth, 37.5% of active managers outperform the index. So it's really like what you said is so accurate, like a coin flip, like 50-50. If you choose a mutual fund versus an ETF and then you compare it 12 months later, there's a 50% chance that your manager, who you're paying an extra high fee to of that soft cost, you're paying an advisor advisor fee, and then you're paying the cost of the portfolio itself. That may be another 0.5% to 1% if you choose it. There's a 50% chance that you beat by just choosing a low cost index that you may be paying like 5 basis points to or 10 basis points. So literally a tenth of the cost in most cases. But as you said, if you spread that over 20 years, I'm just looking at, Morningstar data right now. So US large growth, the amount of mutual fund managers, active managers have outperformed the index is 4.7%. That's less than 5%. So less than 5 out of 100 companies. So if we spend our time, first of all, going back to the principles that Ben, you started the podcast with, we asset allocate, we diversify, and we're long-term investors. So we're not making decisions over short term. We're making tactical moves while maintaining a long-term time horizon always. And you should never put money in the market unless you have a long-term time horizon. So therefore, everything fund that we invest in, we're looking at lifetime returns, lifetime results. So if you look at the 20 years, what we've evaluated is what you're guaranteed with the active manager over 20 years is you're guaranteed to pay 10 times the fees you would with a passive manager. You're also guaranteed, based upon historical data, over the last 20 years at least, so not guaranteed in the future, this could change, but only 5 out of 100 of those active managers have outperformed just simply following the index. So we could spend all of the time and research and money to go try to pick out those 5 out of 100. That's a really high cost of failure and not something we're comfortable with putting clients through. You're guaranteed to pay 10x the fees and there's a 5% chance it doesn't work out. That doesn't make any logical sense, right? So now that we've clearly covered an ETF and a mutual fund, that completely changes when we're looking at international. If you look at the foreign large blend, the data is similar in the 1, 3, and 5 year, but if you go all the way out to the a 15 year, it's 24%, or even 20 year, it's 18.9% of active managers have outperformed, and then in emerging markets, it's 38.4%, and then in Europe specifically, over 15 years, 40% of active managers have outperformed. So it's not a coin flip 50%, but I do want to state that there's so many players out there that say, oh, we have an actively managed, we're going to tag a 1% fee and we're going to do all this research internationally. And so I think the players are really skewed because every company has this international offer. But when you look at really the good companies, the big companies that have the firepower, Nick explained to us why we've been able to consistently research and why we have some active plays internationally only.
Yeah, I mean, for us, it really comes down to the exposure to information in efficient markets versus inefficient markets. So for us, we're not fully active in the international space. We are a bit of a blend there, active and passive. But we see incorporating active management in the international space as being a boon to our portfolio because we're going into some of these inefficient markets and we're paying for active managers and their active due diligence and research in areas where economic and political changes may be happening pretty frequently. We want to be out in front with an active manager who's pricing that accordingly and making the changes on the spot to try to like capture some of that positive volatility there, versus an ETF strategy, which really is not making those active plays. It's not making those aggressive moves to the portfolio, and reacting to that information in the amount of time that an active manager would. So again, we're not saying fully active in international, but we do see, as Matt said with the numbers, we do see a benefit to having an active play in those market segments.
Absolutely. Well, Nick, thanks for sharing so clearly all the difference between the ETFs and the mutual funds, and specifically how we use information to build the EWA portfolio. Thank you. All right, Ben, let's get back to just, basic client questions. So what are some compelling reasons, why, obviously, if you look at the last 5 years, it's like, why did I have anything international? Obviously, we still have them underweighted significantly compared to US, but we're maintaining those positions. So let's look at the data of if US does this percent, what does international do, and then vice versa. And let's make the case of why we should stay the course, other than just clearly risk adjustment in the portfolio and life by design. But let's just get really nerdy here for a second.
Yeah, so let's just go back, and we touched on this a little bit in the beginning of the podcast, but let's go through, just running through exactly what you said. So from 2008 to 2022, the S&P 500 averaged 8.8%. So very strong 14-year time frame for U.S. equities. Over that same time frame, 2008 to 2022, the developed market, so MSCI index, averaged 2.3%, and the emerging markets index averaged 1%. So exactly what we just said, and this is the crux of all of these client questions. International has performed so poorly over this 15-year time frame. Why don't we move more into the U.S. equities to achieve those types of returns? Well, let's take a step back and look at the years prior to 2008. So from the 8-year time frame from 2000 to 2007, the S&P 500 only averaged 1.7% annually over that 8-year time frame.
And that was after you said, what was the time frame again?
2000 to 2007.
Okay, so that includes the tech bust, and then even some strong years in recovery. So you're basically flatlining.
Correct.
Those years.
Correct. And over that 8-year time frame, again, S&P 500 1.7% returns, the developed market index 5.6%, the emerging markets index 15.3%. So if we were sitting down recording this podcast in January of 2008, after that 8-year run where international has just crushed it over United States markets every year, the questions we probably are getting from clients are, hey, why are we even in U.S. equities? Why don't we just move 100% to international? Look at the last 8 years. Like, why isn't this run ever going to stop?
Clients would probably want to physically move international out of the U.S. after those kind of returns.
And so the script has completely flipped. And again, this is 15 years ago. So this is in the context of someone's financial plan. If they're saving for their financial independence, if they're saving for education, these are conversations that have completely done a 180 from 2008 to when we're recording this in 2023. And so that's all to say that just because something is familiar doesn't mean it's safe. And so the math says one thing, but the recency bias, we always need to keep that front of mind. Just because something has happened over the last couple of years doesn't mean it's going to happen in the future. I'm an Ohio State football fan. The last 2 years, Michigan has absolutely destroyed Ohio State. However, recency bias is kicking in. We're forgetting the 10 years before that when Ohio State absolutely stuffed Michigan into a locker for 10 straight years. So again, that mean,
first of all, that sounds like bullying. And second of all, which I know Ohio State would do because that's just who they are. And then secondly, I'm saying Michigan's going to win again this year.
If
you want to go on public and make a little bet here, we're happy to do that.
I did just watch the Swamp Kings documentary about Urban Meyer. So yeah, there probably was a little bit of bullying in that time frame. But back to recency bias and how it equates to U.S. versus international. Really powerful statistic. If we look at 10-year rolling periods, U.S. returns versus international returns from 1970 to 2020. Years in which U.S. returns were less than 4%, international outperformed U.S. 100% of the time. So again, from 1970 to 2020, a 10-year rolling return in that time frame. U.S. under 4%, international outperformed every single time.
So 1970 and 1980, 1971 and 1981, 1972 to 1982. Every 10 years that the U.S. didn't do well, international crushed.
Correct.
Got it.
Same exact scenario. If U.S. returns were under 6%, international outperformed the U.S. 94% of the time. So 62 out of those 66 rolling periods, international outperformed U.S. So it just goes back to...
And one thing you just said, like real quick, is like, so there were six... That's crazy. I mean, 66 of those simulations, the U.S. over those 10-year rolling periods were under 6%.
Yeah.
So it's so, with all the data that's out there, I mean, it's so many people want to finick with like mess with the portfolio decisions, and like you can get 95% of your results if you stick to the basics. Mm-hmm. And this data is so important why you should stick with the basics and not just jump on to the next fad. So anyways, I had to say that.
Even just, again, if we looked at, 10-year rolling returns, if we just look at all of those returns, period, just annually, U.S. outperformed international 54% of the time. International outperformed U.S. 46% of the time. Again, at the time of filming over the last 15 years, it would seem as though U.S. has outperformed 80, 90, 95% of the time based on what we've seen. But historical data match just hasn't shown that.
So over the last 50 years, the U.S. has outperformed over 10-year rolling periods, depending on what month you're starting, or 54% of the time. So it's almost a coin flip if you were to say, over the next 50 years, if someone was to say, "I would never recommend this. Do I invest everything in U.S. or do I invest everything in national?" Looking back 50 years, it'd almost be a coin flip of, if you're looking at 10-year increments of which one was going to do better.
Yeah.
But if you have both, we know you're going to reach your goals, your family's going to be secure, and we can do so with the least amount of risk. And so that's why we don't pick between international and U.S. That's why we don't pick between small cap and real estate. That's why we don't pick between mid cap and developed markets internationally. That's why we have everything in a diversified asset allocated portfolio, because we're most focused on clients living their best lives by design and making sure that they have no financial regret and that they're secure the whole time with peace of mind. And that's the best way to achieve those things, is what we found analytically, but also, just like in the trenches with clients and going through problems that arise and solving those problems, on a daily, weekly, monthly, yearly basis for clients. You have to manage peace of mind. You have to manage risk. It's just not just a simple return equation looking backwards. It's much more. You've got to be much more thoughtful than that.
Yeah, totally. And just on top of that, because the math is one thing, but I think behavioral analysis is another thing. I think most people that either have these questions or are thinking about these topics, whether they want to admit it or not, have a home country bias. They feel like they have a better understanding of U.S. markets, whether it's large cap, mid cap, and small cap, than international, and they just generally feel more comfortable investing in their home country as opposed to international markets, international funds, whatever it may be. There's a really powerful example of this. If you look at the country of Japan, in the 1980s, completely outperformed U.S. equities, completely outperformed the rest of the international space each year, 1980, 1981, 1982, all the way through the 80s. So if you had said, again, if we were having this conversation in 1990, hey, Japan's crushed it for the last decade, why don't we have more exposure into the Japanese markets inside of our international space? Why don't we be more heavily weighted there? From January of 1990 to May of 2023, the MSCI Japan Index returned 0.9% per year. So over that 33-year time frame, if you were invested heavily in just that Japanese index, less than 1% return per year. So taking a step back, again, what does that mean? Two things. Number one, just because something has happened over the last 10 years doesn't mean it's going to continue in the future. And number two, be aware of any sort of home country bias. So if you were a Japanese investor in 1990 and you said, I understand Japanese markets. This makes sense. I don't understand all the international markets. I want to be invested in the Japanese markets. That would have been a bad decision over the last 33 years. But if you were a Japanese investor in 1990 and you said, I'll be asset allocated, I'll have international exposure, which means other countries, which means U.S. markets, you would have had certainly a stronger investment return than simply just being in the Japanese markets.
No question. All right, so I think we've proven on this podcast that we're not market timers. We're not picking segments. We're not gambling. We're not stock pickers. So because we're not, let's at least try to have some fun and act like we can pick some stuff. So Nick, I see you're wearing the shirt. You played Eastlake this year at a charity event, one of the charities that we support. So the final FedEx Championship is there. I think it starts today. Ben would know this.
It does, hypothetically, but
all right,
I don't know that for sure.
So who do you think's going to win? There's 30 people left in the field. Who's your pick?
Well, they start with a staggered start. So again, Scotty Scheffler is going to be starting the tournament at 10 under. I believe Victor Hovland will be starting at 8 under. Rory McIlroy 6 under. So Scotty Scheffler is the favorite. He's coming in with a 2-stroke lead. He's earned it. He's number 1 in the FedEx Cup. So if you're maybe pick someone, I'll say Scotty, but that's certainly the boring answer. I would not be shocked to see Hovland or Rory get hot and take it.
Yeah, it's like picking. That's basically you saying I'm going to invest in U.S. stocks because they did so well in the last 15 years. I'm just saying.
You know what?
Little.
That is true. It's hard to argue that.
No, he's got a nice swing. He's consistent. Nick, how about you?
I mean, once you get down to the final 30 in the FedEx Cup, it is a little difficult to set that format. And I believe since they've adopted the formats, nobody has come back to win that started anywhere less than 4 under. So they tier it. So Scotty will start at 10 under, and I believe the biggest comeback, somebody started at 4 under. So I mean, if
was
you
that
take a
Rory
look at,
last year? Because he was pretty.
Was it Rory when he came back?
Rory definitely.
But,
I mean,
he came from.
yeah.
Pretty
He was.
far back,
Yeah, he was
but-
back. He was back.
But the nature of it, certainly you might have an outlier year in there somewhere, but by nature, you're really kind of isolating it to, the top 10 of the 30 have an overwhelming, chance of taking home the title here. It is a boring answer, but Scotty Scheffler would potentially be mine as well, just
come
because for an additional reason, because of his heartbreak last year. He dominated last year. He was right there. He got to the final round of the FedEx Cup at Eastlake, and I don't want to say choked because I think he shot maybe like a 70 or something.
He had a bad
but
final
it was right there for the taking, and Rory just went off the last few rounds and took it from him. So
I'll throw a dart on Wyndham Clark at 4 under. Eastlake's a birdie fest. Wyndham can make birdies. He's not coming in with amazing form, but if you're gonna make me pick someone that's a little bit off the radar, give me Wyndham. I think he wants to get in good form before the Ryder Cup in Italy in September.
I think. All right. I'm just
Matt's
saying. You guys
gonna
were
Brian
phenomenal at the international. But you may want to consider being like sports announcer. I think you prepared more for this than you did for the. No,
That
I'm
was
just
all
kidding.
off the top.
All right. Well, I guess I'm gonna go with what's Ricky. I love Ricky, but is he like even? What's his?
He's back there. He's back there.
I'm
All right.
actually not sure his starting.
Ricky's my long shot. That's who I hope wins. Him coming back this year. But I'm gonna go with John Rahm. He's right up there, right?
Yeah.
So Rahm's 6 under.
Yep.
Rory's 7 under. Wyndham is 4 under. Ricky is 3 under.
All right, so Ricky's got a shot. Well, anyways, back to the scheduled programming. Thank you for joining us on. By the way, by the time this is published, this golf will be over, and you'll see who's the smartest person on the table here. So, anyways, thanks for joining.
Did you
And
make a pick? I'm sorry, Ricky and
Ricky Fowler's my long shot because you picked 2. You said
did.
Wyndham.
I
I
did.
threw John Rahm out there. Yeah.
So you're Scotty and John, and I'm John.
I
Is
thought you threw John Rahm.
yeah, John's my number 1, who I think's gonna win, and then Ricky is who I hope wins.
Okay.
Just saying.
I
All
like
right.
that.
I'll write this down.
Thank you, everybody. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.